me, Mario. Very important PSA message for all of you. Please do not let Dr. Mario touch you. He is not a licensed doctor. Hey, what's up? I'm Russ, and this is Dapper Dividends, where we are helping you build tomorrow's passive income right here today. And I hear you're burning up because you want to know the top 5 dividend-paying pharmaceutical companies in the world. Well, sit back, relax. I got the medication for you. Open up, because we're going to start with dose number 5. So Eli Lilly is a drug firm based in Indianapolis, Indiana. What up, Hoosier State? And they focus on neuroscience, endocrinology, oncology, and immunology. Lilly has key products like Verzenio for breast cancer, Humalog for diabetes, and Olumiant for rheumatoid arthritis. They have a market cap of $220.1 billion, a current revenue of $25.4 billion, and current earnings of $7.2 billion. And year to date, their stock is up 39%. According to Seeking Alpha, they have a dividend yield of 1.47%, annual payout of $3.40. That's a low payout ratio of only 42.96%, but growing that dividend at a whopping 10.14%, and that has been growing for 7 years. Now, I always say it, and I'll say it again. A lot of these companies here are strong companies that you want to buy and hold. And as I always say, buy companies that do money. Treat yourself right. You work hard for your money. You want to gamble a little bit on penny stocks? I gamble a little bit on penny stocks. What up, HCMC? But like Warren Buffett said, I think it was Warren Buffett, that in the short term, the market is a voting machine, and in the long term, it's a weighing machine. And what that means is when companies make money and they consistently make that money, grow their revenue, their earnings, then their stock is going to go up because people want parts of businesses. You want to own businesses that make money. Let's buy those businesses that make money. So Lilly is developing a potentially blockbuster Alzheimer's drug. And from what I found researching, the FDA has a much lower approval threshold for the Alzheimer's drugs. So Lilly is also increasing their focus on unmet needs in the oncology and neurology areas. And I think they should be solidly locked in the top 10 for years to come. Coming at you out of the land from the north where the reindeer roam, give me a home in Denmark, is Novo Nordisk. Now, they are the world's leading provider of diabetes care products, manufacturing insulins such as Actrapid, injectable diabetes treatments like Fiasp, and human growth hormone treatments like Sogroya. They have a market cap of $234 billion, current revenue of almost $49 billion, and their earnings currently sit at $8.8 billion. Novo Nordisk stock is up 42% year to date. Dividend yield 1.10%. Annually, also paying out $1.10. Their payout ratio is 34%. That's really low. 5-year growth rate, though, nothing to write home about, less than 1%. Been growing that dividend for 2 years, and they do pay that dividend twice a year. Unfortunately, I don't think that diabetes and obesity is going anywhere anytime soon. So as long as these are prevalent in the world, then Novo Nordisk is going to have a share of that market and strong cash flows coming in. So they do have drugs that are being studied in the area of liver disease and Alzheimer's. So if they can crack that nut and get some products that are doing good in the world, then look out. Novo Nordisk is only going to go up from here. And I think they're just a solid international company. You know them, you love them, Pfizer. They are one of the world's largest pharmaceutical companies, and the majority of their sales come in from prescription drugs and vaccines, including the pneumonia vaccine Prevnar 13, cancer drug Ibrance, and cardiovascular treatment Eliquis. They have a market cap of $246.2 billion, current revenue of $50.1 billion, and their current earnings are $13.4 billion. Pfizer's stock is up 20% year to date, a very, very nice yield of 3.55%. Their annual payout is $1.56, that's paid out quarterly. A low payout ratio of 38%, very nice 5-year growth rate of 6.47%, and that dividend has been growing for 11 years, which makes Pfizer a dividend achiever. Dividend achievers are simply companies that have been growing and increasing their dividend for at least 10 years. So Pfizer's pipeline is improving with recent launches like the cardiovascular drug Vyndaqel, which is a treatment for the rare and fatal disease transthyretin amyloid cardiomyopathy. I mean, Pfizer just has such steady cash flow that I think they have no problem being able to support that 3% plus dividend yield. I've told you over and over that Switzerland has more than cheese, chocolate, and yodeling. They also have Roche, which is a biopharmaceutical and diagnostic company that has a growing pipeline, and they are on the front lines fighting COVID with testing and prevention products. They have a current market cap of $319.1 billion. Their current revenue is $68.4 billion. Their earnings currently sit at $19.3 billion. And Roche is up 3.8% year to date. Dividend yield 2.65%, paying that out annually $1.22. Remember, that's one payment a year. Payout ratio is 45%. 5-year growth rate, not that great at 3.7%, just slightly pacing inflation, and they have been growing that dividend for 2 years. So Roche has a solid history of generating oncology therapies, and very interesting, they have their drug development and diagnostic groups in-house, which I think gives them an advantage and a leg up from what I've studied and read to keep them in the top 5 of the pharmaceutical sector for years to come. You know them, you love them. Hats off to my dividend darling at the tippy top of the list. They are the world's most diverse pharmaceutical company. They have 3 segments that keep them up there, which are medical devices, the pharmaceuticals, and their consumer goods, which you know, like Band-Aid, Tylenol, and AccuView contact lenses, which I do wear, and the rheumatoid arthritis drug Remicade. They have a market cap of $431 billion. Their revenue is currently $89.1 billion, and their current earnings, which is EBIT, their earnings before interest and taxes, of $22.7 billion. And Johnson & Johnson is up 4.6% year to date. Dividend yield is 2.57%. You know, if their price drops, I'm going to be buying, because when the price goes down, the yield goes up. Their annual payout is 4.24. Look at that payout ratio, 43.8%. That's so low for such a big blue chip badass like J&J. 5-year growth rate is 5.96%. It could be a little better. Not as good as my Pepsi, but I'm okay with that. And the cherry on top, they've been growing that dividend for 59 years. Yes. Most of Johnson & Johnson's near-term patent losses are indeed for hard-to-manufacture products, so that should help limit them from competition. So their diverse healthcare segments on top of key drugs and that stellar growing dividend, I think this is one of the places that you want to be for the long term. This is what should help shield them from severe market downturns. And when Johnson & Johnson's price drops, you know people like me are going to be helping ourselves gladly and taking more of those shares off the market and putting them basically creating family heirlooms to pass down to future generations. Hey, we loved having you here on Dapper Dividends. And if you were helped in any way, shape, or form, I would encourage you to please consider hitting the like and subscribe buttons simultaneously. I want to see you do it. And if you'd like to hear my very unique story, how I became a dividend growth investor with no cuts, no edits, click the video right here, and I will talk to you there.